This is the beginning of part 2 of our module on asset swaps and z-spreads. We remind you that this part 2 contains chapters 3 to 5 of this module, with chapter 3 illustrating and analyzing a non-par asset swap through the par-par asset swap mechanism. Chapter 4 explaining the concept of the z-spread and the limitations of this measure, and chapter 5 containing the module's quiz. This chapter 3 tackles the complexity mentioned briefly in chapter 2 by teaching you how to structure and price an asset swap package for a bond that is not trading at par. The chapter also explains the principal difficulty in using an asset swap spread measure to estimate a bond's risk relative to paper of the highest credit quality. We begin by simply reverting to our most recent diagram and replacing the Alcatel bond's coupons with its yield to maturity, since this measure reflects better the investor's true economic return over the life of the trade. We now see a yield to maturity of 7.45% semi-annually arriving under the bond, and our old payment of 6.30% under the swap. And when these are netted off as before, lead us to an all-in return over the life of the package of LIBOR plus 115 basis points, rather as we had anticipated. Throughout the rest of this module, we will refer to this theoretical spread over LIBOR calculated in accordance with this method in exactly this way, i.e. as the theoretical spread, which we will be contrasting with two other measures known as the par-par asset swap spread and the z-spread. But it is one thing to use the mathematical construct of yield to maturity to think about a bond's economic returns more accurately. It is altogether another thing to generate actual cash flows for the investor that supplement his original cash flows and bring his cash flow return somewhere up to the LIBOR plus 115 level. How might this be accomplished? The most traditional way of tackling this problem is described on the diagram about to develop in front of you, and is referred to as a par in, par out, or simply par-par asset swap package. Throughout this discussion, we will assume the bank counterparty to the investor is rated AA, more or less, and therefore able and willing to fund itself at or close to the swap rate for at least short and medium-term maturities. Under this par-par asset swap structure, step 1 involves the investor making a payment to the bank of a full $100 despite the 8 percentage point discount at which the Alcatel bond can be purchased. Note very importantly here on the left of the diagram that this now means the investor has funded at LIBOR a full $100 rather than just $92 as before. Under step 2, the bank purchases from the marketplace the Alcatel bond for $92, but with a face value of $100, and passes it on to the investor, which leaves $8 unused so far. Under step 3, the bank provides or enters into a 5-year semi-annual IRS with the investor, as described before, which converts the bond's cash flows of 5.5% into LIBOR minus 80, as explained previously. Under step 4, finally, this unutilized $8 we mentioned a second ago is loaned internally to the bank's funding desk, with the request that the funding desk kindly return this money to the investor, inclusive of interest at the desk's funding rate, over 10 semi-equal installments. So an annuity of 10 payments, semi-annual, whose PV must be $8, that just appeared in the diagram. Assuming, as mentioned above, that the funding desk regards the 6.3% swap rate as a reasonable proxy for its funding cost for the proposed 5-year maturity, we proceed to calculate the net amount in dollars of each periodic installment on worksheet annuity, which is coming up next. This simple worksheet annuity starts with the insertion of $8 for the PV, 10 for the number of payments, 6.3% for the discounting rate, and 0 for the face value, since we are creating a pure annuity, i.e. a stream of cash flows of equal size with no balloon payment at maturity. Now in cell C9, we have inserted the formula PMT for PMT payment and proceed to cross-refer carefully to each of the entries we just enunciated, making sure, however, to reflect correctly, as we do here, the semi-annual frequency where it is still not reflected. The result in this cell C9 turns out to be 0.95 of $1 semi-annually, which is revealed in the cell underneath it in basis points to be 189 basis points annualized through this very simple multiplication you see here. It is customary for the bank to pay this money, i.e. the 189 basis points, to the investor as an add-on to the fixed leg of the IRS, rather than as a separate payment under a separate contract. We are able now to visualize the end result in this diagram, which merges together the two sources of payment to the investor, revealing an all-in return, of course, of LIBOR plus 109 basis points. This is no longer some theoretical mathematical construct that cannot be generated in real life, nor does it leave the investor earning a negative cash flow spread relative to his LIBOR funding cost as before. The cash flows of LIBOR plus 109 are based on the same national amount of $100 as the funding cost of LIBOR. Remember again, importantly here, that under this structure, the investor truly is funding $100 up front, so is paying LIBOR on this total dollar amount. And also, these cash flows occur on the exact same semi-annual dates as the dates on which the funding payments of interest must be made. And again, unlike the previous illustration, the investor's initial cash outflow of $100 is now accompanied 5 years later by an exactly equal cash inflow of $100 as well, while the cumbersome $8 of capital gain encountered previously has been made to disappear. And yet, we cannot help noticing the 6 basis points difference between this 109 spread over LIBOR we accomplished under this structure and the 115 of theoretical spread over LIBOR suggested by our earlier calculation. It would be impressive if you were able to explain this difference without assistance, but please take a few moments if you attempt this, as the answer is far from obvious. Click pause until you are ready to proceed. The small discrepancy stems from the fact that the theoretical spread of 115 basis points represents a slightly riskier investment than the par-par asset swap structure. This is because the original yield to maturity calculation of 7.45%, which was the source for the 115 basis points of positive spread over the 6.3% IRS rate, represents 100% Alcatel single A credit risk, while the par-par asset swap structure really blends together $92 of Alcatel single A risk in our illustration with $8 of risk against the bank's funding desk, which of course pays for funding only the substantially lower 6.3% interest rate, corresponding more closely, as you know, to a AA funding level for a 5-year horizon. So, in sum, the investor is in a sense diluting, as it were, his return versus the theoretical L plus 115 by blending L plus 115 on $92 with a lower LIBOR flat on the remaining $8. Since the 6.3 paid by the funding desk becomes LIBOR flat once it is swapped into floating for 5 years. And all this gives rise to L plus 109 as a sort of weighted average. Stated another way, if it turned out that Alcatel had a 5-year FRN trading at par and yielding LIBOR plus 109, the asset swap package would actually be slightly more attractive, since it would generate the exact same cash flows for the investor, but with marginally better credit risk on a weighted average basis. This leads to the obvious question whether a better structure would be to invest the $8 surplus not with the bank's funding desk, but in another 5-year semi-annual annuity issued by a single A rated entity willing presumably to pay single A funding rates of 7.45%. But the problem with this is twofold. One, if this single A entity were another bank or financial institution, always on the lookout for funding for pretty much any maturity and frequency, provided the numbers are right, then here things would work out correctly from a numerical perspective, but the product might become a little complex for the investor, who might struggle with issues of credit line allocation, risk weights for capital purposes, possibly some accounting matters, and so on. Problem 2, if instead the annuity were issued, let's say, by Alcatel itself, and therefore was priced of the same 7.45% funding rate as Alcatel's outstanding bond indicates to be appropriate, then the product complexity diminishes substantially, as would several of the difficult questions we just enumerated. But Alcatel is frankly unlikely to have a funding desk with the same voracious needs for funding and sophistication as a large financial institution, and therefore typically this approach is rare. If it were possible, however, our calculation would be amended as follows. First of all, in our previous worksheet, annuity, we would replace the 6.30% rate that you see in cell C5 for the swap rate with Alcatel's semi-annual 7.45%, expecting the value of PMT at the bottom to increase from the current 189 indeed to about 195 basis points, rounded to the nearest decimal. Then, in our previous diagram showing the par-par asset swap package, we would replace the 189 annual basis points that the bank pays under the annuity to the investor with 195 basis points that Alcatel would pay, and when all arrows are collapsed together as much as possible, our diagram would reveal triumphantly the all-in L plus 115 that the yield to maturity calculation alerted us to. We have reached the end of this chapter 3.